Welcome to This Week in Coworking, where industry leaders get succinct, actionable insights.
Hey everybody, and welcome to another This Week in Coworking podcast. I am joined by the formidable, the impressive, and always happy to see you, Tim Slaughter.
Good.
Tim, how are you?
I'm glad to be happy to be seen, man. That's a great intro, you Hector.
My absolute pleasure. And it's great to have you here. This is a really special episode. I always love chatting with you, but I also love chatting with people who have been in the newsletter recently. And you were in the newsletter a couple of weeks ago when we talked about the fact that the firm where you're leading at Caddo Office Reimagined just turned 16.
Yes.
Like that is, that's impressive,
Yeah.
right?
It really is. Thank you. And, I was I guess we missed the 15th anniversary and we didn't really celebrate that. But the 16, I kind of looked up and I'm like, wow, we started in 2009 and we've come a long way. I think I clarified in the article that we haven't been in co-working for 16 years. We've been in the office business for 16 years. So very different business model today than what it was 16 years ago, for sure.
And Tim, that's where I want to start our conversation, right? You weren't always in co-working, as you said.
Yep.
When did you start dipping your toes into flex?
Sure.
What drove that?
I think you can rewrite history, but it was sort of there from the beginning. The first building that we ever purchased was in 2010. And one of the reasons we were able to buy it so cheaply is that we were in the middle of a great financial crisis at that time, which meant that office buildings were not really trading and people weren't signing new leases. So that was a big thing. The second opportunity was there was building that was 172,000 feet, which is a decent sized office building, not ginormous, but for your first deal, it's big. But it had 73 tenants in it, which meant, the average tenant size was fairly small. And we were buying from an institutional seller, a REIT, and they preferred assets where there was single tenant leases. Those are much easier to manage and administer. And so I think one of the reasons we were able to buy this at such a low price was that, the difficulty. Now, we just thought, hey, great deal. And we didn't know what we were getting into. As it turns out, having 73 tenants is a lot to manage, especially in that traditional world where you have, 3, 5, 7, 10-year leases. They're always renewing. You're always trying to get new tenants in. Some issue going. Somebody needs to expand. Someone needs to shrink. It's just a lot of plates to keep spinning once. So, but because we served a lot of neighborhood, smaller business tenants, we learned over those first few years that we really identified with the small business owner who was in our space versus maybe like Wells Fargo, who was also in our space. We never met any of the owners of Wells Fargo, no surprise. We didn't even meet their real estate person, which is no surprise. But the small business owners, we ran into them in the hallway. We negotiated in person. We got to know them. We could use their services. There was a guy who was an insurance provider. We bought our key man life insurance from him. So we just felt a high degree of kinship and camaraderie with the small business owner. And I think that's what we want. That's where we got our passion to serve the small business owner.
So you had a building, 70-ish leases, and you thought, you know what? Juggling these plates on 3-year terms was too much.
Yeah.
Let's shrink that. Let's give them kind of month-to-month leases or slightly shorter terms. When exactly did you feel you went into co-working?
So I'd probably say we started kicking tires in 2017. Now, let me back up. We were a landlord, so we had several run-ins with different co-working concepts who wanted to lease from us and occupy space, including a predecessor of what's now Lucid. We negotiated, didn't get to terms. We negotiated with Regis, didn't get to terms with that first building. We ended up doing a deal with them in a subsequent building. So we were kind of around the industry, but we understood it more in the executive suites arena. I would say in 2017, thereabouts, one of our investors said, hey, there's a guy in the suburbs of Dallas who is building his own co-working called Jager Office Suites. He's got 4 locations in the North Dallas suburbs. I think you should come tour these with me because I think he owns the buildings and we could buy the buildings and then, sort of learn the co-working business through acquisition. And so I would say our journey into co-working has been entrepreneurship through acquisition because we are fairly risk averse. If you are risk averse, it's much easier to start with a concept that's working and then adjust from there. And so that's what we did. We took this very successful Jager Office Suites concept. They had 12 locations open. So we only bought 4 of them. There's 8 more that are still operating in Indianapolis suburbs. And that's where he started and honed the concept. So there were 15 years of product development, opening new locations. So we really, if we're going to start something new, we're just like, hey, let's just buy this and operate it the way they operate it. And then if we see any flaws or things we can improve upon, we knew they were below market on rent versus like a Regis or a Lucid. They were about 75% of them. So we're like, okay, well, there's opportunity there. But we didn't know what other opportunities might be there. And as we got into it, we found more. But I would say for the first year, my mantra to myself was, God, please don't let me screw this up. Like, don't let me, these buildings are all 100% full, waiting lists, cash flowing really well. Let's not do anything to scare off that cash flow. And so very true to the original concept for a long time. And I still think it's fairly recognizable to the owners of Jager. I mean, we still talk to our openings. And so, anyway, but very, very glad to be in it. So we actually closed on his buildings in 2019. So we've been in co-working for 6 years officially.
Got it. That's a fascinating way to go into it. I mean, we spoke to a lot of folks who they kind of experimented internally, but buying in and coming into the market that way is also really, really fascinating, especially now looking at what's happening in the rest of the market. We've been approached all over the world from people like, I've run a co-working space. I have 13 co-working spaces. I want to get out. I want to move. I want to go do something else. I feel like I'm stuck. And it's fascinating to see this cycle restart where people are like, well, there is a path where someone has acquired a brand, stayed true to it, looked after the members, and have now grown, 6 years later into something far bigger, but still true to what Jager was doing at the time.
Yeah.
So my next question for you then is, since you jumped into an existing model, what do you think has changed the most in your own business since then?
That's
on the co-working side.
Yeah. So it's funny. We just hired a guy who's more of a bricks and sticks asset manager that comes from the commercial, real estate world that we came from. And his first comment, he's been with us for about 45 days now. And we ask him weekly, like, how's it going? What's different than what you thought? And we had a meeting last week and he said, you know what, there's a lot more technology in this and what you guys are doing than what there is in sort of the traditional real estate world. And so that is a noticeable difference that he has seen. And he's more on the asset management side, less on the, he's more on the Propco side, let's say, than the Opco side.
Yes.
And so we kind of just see it now as like the air that we breathe is just like, we've got a provider, an IT provider who just does the networking stuff. We've got another one who does more help desk stuff. And then we've got 6 or 7 packages that we rely heavily on in our technology stack. And I would say our tech stack before that was probably just Yardi Voyager, which was the accounting package. And beyond that, it was Microsoft Office paper. And now we're looking at how do these systems all link together and talk to each other. We're implementing Unity AI, the prospects coming in, which is just beside wonderful, right? And so that's what boggles the mind. And we don't have any in-house IT resources yet, which is crazy as well. I came from a management consulting background, so I have some background. My wife was a coder, so she helps me. The other thing that I would observe that is way different about co-working than traditional is it's much less wasteful. And when I say, you've probably seen all the statistics about how much traditional office leases, like the usage of it is, if you're using it 50% capacity, you're probably for Fortune 500, you're using a lot. And we saw that. And we also saw like we sign a 5 or 10-year lease with someone, and 2 years out, they'd be like, well, this doesn't fit. Either it's too big, it's too small. We need more open plan. We need more clear. And you would just move them into another space and then just trash the space that they were in that you had just spent maybe $1 million, and it'd go in and you'd start over all the drywall and all that. So that's a big factor. I think the flexible model and the standardized delivery of the service means that we don't have to waste as much. And, we take a 11 by 12 office suite, and that's about 70% of our inventory. And it's reused over and over again with minimal construction. I mean, we're talking deep carpet. And so it's a better financial model as well. And there's much less downtime with that. The final thing that I think is really different is just the marketing of it. We're still learning every day about marketing and how to find new prospects. That was not a concern in the traditional office. I mean, we had a book on how to market our buildings, and it revolved around capital expenditures to make it more presentable and boost curb appeal. And then really we would lean on the CBREs and the Cushmans and JLLs of the world to be sort of our outsourced marketing department. The project leasing team would sort of be that marketing department for us. And then we do whatever commission specials we needed to attract the tenant rep brokers who really control the users, and at least in the Dallas market. I mean, so if you paid your commissions quickly, if you got a reputation for doing that, if you paid bonus commissions, if you had broker parties where you gave away, like one time we gave away like a private jet charter. I mean, just stupid stuff. But But we didn't.
The deal's done.
All we had to do was write the check. We didn't have to worry about, as long as we followed sort of that playbook of keep the brokerage community happy, we could fill our buildings. And that is not the case whatsoever in coworking. It is very much a direct to consumer, at least in our world, people out there serving enterprise clients. That's not really our shtick. We're really after the small business, suburban small business owner who wants to be 5-10 minutes from home. So that is still a work in progress. And how do we attract those people? Where do we find them? And by the way, the world is changing dramatically from Google algorithm changes to AI changes to just buyer preferences and patterns. So, and I would say right now what we're really learning is just like, how do we transparently communicate our offering to the market in a way that is useful to prospects? And that's what we're trying to do right now and focus more time on.
All three are fantastic points and 3 trends that I've been following, not only here at Newsletter, but also through our day job, my day job over at Syncaroo. All things that we keep having to go through. It's not only about getting a message out there, but personalizing it, right? Making it reach the right people at the right time. Then putting that into your funnel, making sure that the brokers know what they're doing, but also that your tech stack all pieces together. Absolutely agree with you. There is so much tech in our industry. It goes back to what you were saying earlier, right? 75 leases on fairly reliable 3 to 5 year. You can kind of do that with a whiteboard. I wouldn't recommend it.
You could, or an Excel spreadsheet, but you've got to have the system. And basically all these technologies, Hector, as you know, I mean, a lot of it is they have the process in a box and you're just leasing the process because they figured it out. I think like the Unity one's interesting because it is it's somewhat customizable, but at the end of the day, they have a process, but it's an agent, they're just developing an agent that my agent's probably different than Fuse's agent, and there's some repeatability there, but there's also some get our voice into it and customize in our inventory. But so that's an interesting direction, but there's a certain way that you're going to have to do things if you want to buy it.
Absolutely. I mean, it's really, really interesting because obviously a lot of the conversations I have with execs like yourselves, where it's, what happens if you take away those constraints? What happens if you build your processes and then plug technology in so that it works for you instead of having to retrain everyone? And that is like, from management consultant, that's the dream, right? That is what we as change consultants promise, right? So it's completely interesting how we've gone from like, okay, you buy the pieces off the shelf, and now you're like, okay, but what happens if I only want this and only want this? And that is, yeah, I could do. I'm gonna get off my soapbox
Well,
now.
no, I mean, they're our model. So when we bought Jager, part of what we bought is they had custom developed the software completely,
Mhm.
but they had invested a true. Now this is back, they started probably a
Yeah.
decade ago with their development process, and there's much better tools. But I think they had $1 million sunk into the software,
Absolutely.
a 10 location co-working operator, and that just seemed like a lot. Or Satellite
Yeah.
This Works is a good example.
Yep.
They've done their own now. They're selling it, so they're able to monetize it to other operators. But actually, when we first got into it, we went to Satellite This Works because we're like, oh, these guys are operators for us for a while. The connectivity with our accounting became much more important,
Yep.
especially as we added new locations, taking some of that manual work out of the monthly financials
Yep.
was more important to us. So anyway,
Yeah. And I mean, I could geek out about like things
no,
you've
no,
said
sorry.
the entire time, but I'm going to kind of shift away from that because most folks who are listening to this probably don't want to hear me. So what I'm going to actually do is flip the question on the other side. We've said what has changed, the three main things that have changed since you got into co-working around 7 years ago. What hasn't changed? Like, what
Yeah.
is the underlying fundamentals that have not changed since then?
Yeah. I mean, I think for us, a lot of the traditional landlords in our space would not treat a 2,000 or a 1,500 square foot prospect with any sort of white glove treatment. Those were sort of, afterthoughts. So a lot of the focus and energy would go around the full floor or, multi-floor tenants and what I would call elephant hunting. But what we found is those particular enterprise scale clients were longer deal times. They would extract the worst deal terms for us because they have more power in the negotiation process. And then ultimately, once you get them in, they are the ones most susceptible to mergers and acquisitions and bankruptcy, strategic shifts that are big and that affect their real estate. And so they really weren't best customers, in my opinion. Now, no offense to big companies, but from a landlord's perspective, I'd much rather have, there's 17.5 million small businesses in the US. That's a big market. I know they're flaky. I know they business, but you get to meet the people, look them across the table, tour them through your building. So for me, what hasn't changed is our propensity and desire to do business with smaller businesses that we can learn the ownership. And for us, that even extends on the vendor side. Like our vendors, we like to do business with, we know the owners of companies. If the companies are big enough, can't know them because they've got too many customers or they're too large, then we're usually not a great fit. So I think despite the talk, what hasn't changed is humans still want to be around other humans. And there's a lot of research around weak social ties and just running to people and having a brief conversation in the elevator or at the coffee machine. And I'm not saying that's where our sense of community stops, but I'm saying there's more to that, or being greeted with your name by our manager at the front. There's more to that than we probably gave credit to when we thought just office is just now a dinosaur and we'll never be back. I think that pendulum swung pretty far. And I don't think it's going back to where everyone's full time in the office. I mean, it seems like it's landing on about 3 days a week is where most people would desire it to be. I mean, like our accounting team, I think they're 3 days in the office.
Yeah. Yeah. I mean, I love the fact that your focus on, knowing people's by name, making them feel like comfortable. And, even if they use offices differently, you're still right that they need somewhere. Like they need that central hub. They need that way to get away from the house, get away from the home, get away from the distractions and connect with their teams. So I'm really glad that that has stayed the same, even if it's morphed a little bit around the edges. Tell us a little bit more. You mentioned that you're essentially a landlord, right? Many co-working space operators think themselves as operators, not landlords, but you happen to own buildings as well. So tell me a little bit more about how Caddo is set up. Is it multiple entities? Like, take us behind the scenes.
Yeah. So I would describe us as we're all in on co-working now. We don't have any other investment types. We don't have traditional office. We don't have industrial. We used to, but we burned all the ships and this is all we're doing. our approach is highly vertically integrated. So we do have an opco that is essentially the property and the asset manager and the leasing agent. So that's kind of tenant. And then we have a Propco, which is really the ownership of the buildings. And so that's in place, but we're all, there's a lot of overlap from a salary allocation standpoint.
Mhm.
And then finally, we have two others. We have an investment management piece where we raise money for all of this. And then we have a construction side or development and construction side, not just development, but general contractor.
Oh, okay.
We do it all. Now, we don't do like the janitorials. I mean, we outsource IT and janitorial and HR and payroll, but from the real estate standpoint, we're covering most of the life cycle, all the way from the initial idea to site selection, development, construction, raising the money, refinancing, leasing, managing, all those things.
That's a really interesting model. I'm assuming that every building has a separate Propco that manages that kind of so that, this is the way
Well,
it's done.
sort of. We
Okay.
have a fund structure right now where we have multiple buildings in a fund, typically 3 to 4 buildings per fund. We raise the money, we deploy the capital, raise another fund. We're about to start work on our 11th location in a new market, and we may just raise that one as a single asset because I think at one point we thought it was necessary to have the funds at the ready, in the fund structure, but now we have enough we have a strength in our investor base where we feel like as long as the deal is good, the money.
That's really interesting. I do want to ask you on the financial side.
Yeah.
Is it easier to raise money now for a pure co-working play
Yeah.
than it was 6 years ago?
I mean, I think the headwinds are different than they were. I would say the first round that we raised to buy those Jager buildings was very difficult. Almost didn't happen. You want to know the major problem, and it's something we talked about beforehand, is what's your exit? How are you going to exit? And we could not point to any clear exit. We knew that if we operated well, we cash flowed well, that there would be an exit eventually, because someone, if your cash flow is strong enough for long enough, someone's going to want that asset. And so the last 6 years, we've just been improving the cash flow of the assets. And so now we have a good track record. The business model for us is proven. We still have the question of what's your exit. We haven't. I would say there were headwinds over the last 2 years have been more around why is WeWork going bankrupt? And what's that going to do to your industry? I would say we've turned the corner on that. I think most would agree that WeWork's on the right path, and the ownership is aligned for performance. The leadership is really focused on profitability, and they're real estate guys and they get it. So I think, and then the other headwind that we've had is just the general performance of office post-COVID, and then the increasing interest rate environment that we've been in. So those have all been, but I would say all 3 of those factors are sort of beginning to head in the other direction. So office is looking a little more healthy than it is looking better. Interest rate here to be heading south. And so all those factors are now tailwinds, I feel like, for us, but we still don't have the best answer to what does an exit look like and how do we get our investors' principal back. What we are doing a good job of is returning and making distributions along the way. They're very happy with that. And when we sold them the investment, it was like, hey, this is everything on the table. We're not sure about the exit ideas on what it could look like, but we just timing wise, it's just not like our old stuff. Take a 60% lease building, we turn it into a 95% lease building, and there was a line of institutional investors who wanted 95% leased office buildings that were sort of mailbox money. Anyway, but I think we now, we're in a much better position than we were even 2 years ago from a capital markets standpoint.
Yeah. I mean, it's really interesting as well because we're seeing a lot more talks around exits, right? We're seeing a lot of folks, even REITs, who are the ones originally selling to operators like you to
Yeah.
get rid of the assets, and now being like, well, we want the asset, but we also want it with that monthly recurring revenue.
Yeah.
We want it to be coming in as, thank goodness for like short-term rentals in the Airbnb space, and successes in, nursing and long-term care and student accommodation
Yep.
have all really shown, at least the smartest folks in the PE and capital markets room, that, hey, this is that for office, right?
Yeah.
Why are we buying just the asset when we could buy the business that's now generating that revenue and creating that footfall? So it's really interesting to watch. I'm not going to ask you about what your exit plan is right now, because I'm sure you get that more than enough.
One of the reason we have Opco and Propco separate is we could potentially sell either or both separately, and they are different companies. I mean, you really think of one as the property owner and one as the tenant, and the co-working operation as the tenant. And that's a typical co-working operator, is just the Opco portion of what we're doing. Fit with us as you get on the real estate, and we love the cash flow aspects of it, as you mentioned. And I think the self-storage and student housing are great examples of others who have done. I mean, we had dinner with one of our bankers on Tuesday night, and this guy's been in banking. He's about to retire, but call it 35, 40 years. So old school banker. And for about 2 or 3 minutes, he recounted his investment committee. We just did a refinance and this bank won it, but we had 10 offers to refi this co-working stuff. And like, how'd you get it across the finish line? And he basically enumerated, like, look at the history, look at the cash flow. Don't worry about the underlying, credit of the tenants. There's so many of them that you're insulated. You've got a diverse here, much like you would with an apartment or self-storage or any number of assets that are sort of non-credit. And so it performs much less like an office building and much more like the self-storage and multifamily, which those have been pretty good investment classes. Problem is the overall market hasn't recognized that yet. Well, and there's not good data, comparable sales. But I wish we had a better data set for our industry. It would begin with everyone just, being more transparent about their pricing and inventories and things like that, like hotel.
We're definitely seeing trends like that out in the UK, where, the WIN network, the Workspace Intelligent Network, they already are aggregating insights from multi-location operators.
Oh, they are.
Anonymizing it centrally and kind of releasing those benchmarks, mostly because Blackstone's making a move to get out of their positioning there. So that's those two things, that going onto the public market and just aggregated benchmarking together can push, capital markets to be like, hey, this is an investable category. Let's dive in there. But it's all happening in the US. And I'm racking my brain because I'm like, we know the technology exists to anonymize, share, and kind of benchmark this data because we built it. So we know it's there. Just getting everyone to want to play.
Who's the player? I mean, in my opinion, it would be more of a disinterested third party than a proprietary network. Like, WeWork's trying to do the affiliate network. Probably some, I think, Regis or IWG's had the Instant Group. To me, it's probably more likely that it's like a CoStar LoopNet kind of group that is really, they don't have a dog in the fight, so to speak, and that they've always been that for the office and industrial industry, that source of market data, and just getting it, because part of it is just characterizing the products, like 4-star, 5-star, suburban office, medical office. I mean, within co-working, we have some distinctions that need to be made. And how do you compare? Like, are we comparing per suite per month, per square foot per month, per one-person suites, two-person suites, team suites? Well, team suites could be 5 people, it could be 50 people. So there's just a lot to be thought through, but there's a way to do it. I mean, it's not rocket science. So.
It's absolutely a programmatic challenge. And these are the challenges I love. Thank goodness there is a newsletter called This Week in Coworking. That could be that unified standalone. So let's start at the next conference. Let's get a roundtable all together and be like, okay, where do we need to start? What is the easiest way for us to show the value that you were all doing, and start with that?
Well,
and then we'll improve it from there.
Juicy Boston. I mean, it was the first time I saw CoStar LoopNet at a co-working conference. They had been before, and they had also, Well, I'm just saying, like, they had a booth. I talked to them and I bugged them. I was like, I love your platform because I'm a traditional landlord. And I think a lot of people want the data that you have. Here's my issue. I can't list my prices with you because you convert them to price per foot and I look ridiculous. Now we have an option where you can do per suite per month. And since that conference, we have been listing our prices like on LoopNet per suite per month. And that has been great, and I'm like, gosh, why did it take? I had been saying it for probably 4 or 5 years and then it just happened and I'm not responsible for it, but I'm just like, how hard can it be?
Yep.
One toggle.
This is like the power of connecting in real life, right? Industry events, industry connections. This is why they matter, because we get to sit across the table from vendors, sit across the table from decision makers and be like, okay, what do we all need to do to grow the pie?
Yeah.
So absolutely love that, Tim. What opportunities or trends are you most excited about looking for?
Yeah. I mean, the stock answer is going to be AI for everything, but talking about the pendulum swinging, I think, some of the early returns so far is like, oh, we're not going to hire any new people. She just graduated. It was a very tough market. And I think part of it is people can't hire any. We don't need these young people because AI can replace them. I don't think we're quite there yet as far, it makes these big jumps, but it's not, you need someone to treat it. You need the connectivity between systems to be set. I mean, so I think the jobs are changing, but you still need people. So I think that's good. I think there's just going to be more and more to the tech stack, unfortunately, or fortunately, but I think there's a trend towards self-service, right? And that's a long running trend, people it started with Uber. I mean, the experience with Uber, right? When you used to do business travel, I used to have to carry cash because some of the cabbies wouldn't take credit cards. We had the machines, but they wanted the cash. Just always this haggling and hassling up at an ATM to pay the cabbie. And then Uber just took all that out, and now it's on my expense report, and I don't have to deal with this friction. So I think that's the world we live in, is less friction, and we are not immune from that. So how do we do that? But then at the same time, continue to curate a community of people. And so what's the right balance of that? But I think, clearly we need to do a better job of educating our prospects. That will help us all grow the pie. We're trying to do that in our own ways, but, and also help themselves for the buy. But after the buy, how do I book this conference room and how painless is that? How do I get in the building on nights and weekends, and all the things that we just have come to expect from being consumers of. We're all heading in that direction and we want it. So let's, as an industry, continue to provide that.
I love that. Thank you very much, Tim. Thanks for joining me once again here on the pod. I look forward to seeing you again in person, probably Chicago. If not Chicago, then somewhere. And
New York.
Look forward to New York for sure. Thank you so much again for sharing. If folks want to reach out to you, where's the best place for them to find you?
Tim at caddooffices.com. So, and it's, Siri looks like cadufuses to her. So when she repeats our domain, it's now emailing Catherine at cadufuses.com. Probably some truth in that.
Amazing. So everybody else who's listening in or watching us on YouTube, I will put the link to Cadufuses down below this. Feel free to reach out to Tim. And
we are the doofuses. Yeah.
Thanks, Tim.
All right. Thanks, Hector. Good to see you, man.